But for the stock market right now, it's more like a Russian bear. Good afternoon, everybody. I'm Bill Griffith. Welcome to Closing Bell here at the New York Stock Exchange.
I'm Michelle Caruso-Cabrera in for Kelly Evans. Don't worry, she's back tomorrow. Stocks rocked across the globe from the Ukraine crisis, and the United States is not immune. Let's show you what's going on with the markets right now. The Dow Jones Industrial Average is off of its lows, down 158 points. At the worst moments, it was down 250 points, a decline to 16,163, a decline right now of less than 1%. The NASDAQ also off of its lows. When you look at the intraday pattern, it is lower by 29 points, a decline of 0.2%, was sharply lower about mid-session. And the S&P 500 also coming off the bottom. It is down 13 points to 1846, a decline of 0.75%.
And I think you would agree, this is going to be a very critical last hour
yes, for sure.
of trade today. Let's talk about everything driving these markets lower in our Closing Bell Exchange with Abigail Doolittle from Peak Theories. Chris Whalen is a New York-based author and investment banker and an expert on Soviet history, history of Soviet politics. Brian Jacobson from Wells Fargo Advantage Funds. David Molnar from HighTower. And, of course, our own Rick Santelli monitoring all of the safe haven plays today. Brian Jacobson, you say you want to buy everything you can get your hands on this dip. Why are you not worried about with the rest of the market on what's going on with Ukraine?
I think that this is just an overreaction to what's going on in Russia. Now, don't get me wrong, what's going on is important, but I think that actually how this will play out is going to be an awful lot like we saw back in 2008, where you had the conflict in Georgia versus Russia, where effectively things are going to, the markets will ultimately recover and we'll just take this in stride. I don't think that this is going to actually be reflective of any sort of systemic problems in the market or for the trajectory of the markets to come.
Chris Whalen, we weren't joking. Years ago, when you were a wee lad, you wrote about national security issues and the Soviet Union back at the Heritage Foundation. Now you're in the financial markets. Do you agree with that? Is it okay to step into the markets here because ultimately this isn't going to have a systemic effect on the rest of the global economy?
Well, I think, yes, I do. I think in a tactical sense, this was just one of those headlines that no trader could predict. But on the other hand, you know, the Russians have been trying to keep control of the Ukraine for hundreds of years, going back to Catherine the Great. And I think it's going to continue. They will not tolerate an independent Ukraine. You know, I saw an interesting note this morning. There's energy in the Ukraine that could supplant the Russians as far as being a supplier to Western Europe. So there's a lot of things going on here, and we will hear more about it. I mean, that's it. This isn't going to go away.
David Molnar, you point out rightly, I mean, we're hovering around the 5th anniversary, the beginning of this bull market from the lows of March of '09. So it's getting long in the tooth. We're getting this volatility. Is this market just running out of steam here? Is this a good excuse to sell today?
Yeah, Bill, I mean, I think that's exactly what we're seeing here, is that the market's a little bit extended, a little bit tired after a big run here at the January lows. So, you know, we needed to see something come along that would create an impetus for consolidation, even a short-term correction, and this happens to be it right now. You know, I agree with the prior two guests that this is probably going to be a short-term correction. It's not necessarily, you know, a change in trend here. But I would point out, you know, we do have Friday's employment report coming out that's going to dictate a lot about, you know, the future direction of Fed policy, the future direction or health of the economy. And so I'm not sure that the coast is clear yet. We'd like to see the data come through this week, but certainly this could be the time that we see a pullback.
I think that David is really making a good point there, but something that I haven't heard everybody else talk about is volatility. This year is really all about volatility. When we look at the start of the year, we've seen this massive push towards safety. We've seen bonds, yen, and gold rally. Interestingly, this came right 2 weeks after the Fed's taper, not the reaction that you would expect. So I think that investors are telling us that there are worries out there. The Ukraine situation is just one. The factor there is whether or not if we keep it simple, is whether or not it will affect the corporate profit outlook. If it does, then it's going to have a bigger impact in the stock market. If not, it's probably just a smaller blip, but it's a piece of volatility. And the fact that we're seeing this shift towards safety really suggests that we're going to see continued volatility in the risk assets.
Well,
and I wouldn't be
speaking of the risk towards safety, Rick Santelli, despite all the concerns about the long-term debt of the United States, when the world is terrified, what do they buy? They buy U.S. Treasuries. We get yields lower today.
And gold.
Yeah, you know what, though? I'll tell you, gang, first of all, I do agree with the first couple of guests for a change. Listen, if everybody's been willing all along to look through all the real fundamental news that affects stocks negatively in the United States and say, step in, keep a level head and buy, then for sure that logic should be applied when the Ukraine is the dynamic. you know, in an over-leveraged, every dollar's margin sort of world, in front of Basel, in front of the European banks, trying to get some of the ratios down. It makes perfect sense to see Europe, with Ukraine in their own backyard, and some of their equity markets down. But for the life of me, I just haven't had a good conversation with any of the traders as to why the U.S. stock market is down, or as to why the dollar index really hasn't been flight to safety. In treasuries, certainly yields have gone down, and we can put it in that big bag that it's flight to safety, but overlay an S&P chart or overlay a Dow chart onto the 10-year note yields, and you'll get the right impression. It really is trading tick for tick with stocks. Now, having said all that, if we start to see some settlements under 258, which was the low yield on February 3rd, and the only thing that separates us from comping all the way back to last fall, that would get more momentum. And remember, all markets are trading on algorithmic momentum, not history books at the moment.
And February 3rd was the day that the Dow was down 325 points. So that was that most recent low there, as a matter of fact. Chris Whalen, I mean, obviously, we worry about the impact any economic sanctions could have if there's retaliation. They have the handle on natural gas, they being Russia, on oil. They're the second biggest natural gas and oil producer in the world. So isn't that enough of a worry to start selling stocks today?
Well, no, it is a worry. I mean, we could have a war between Ukraine and the Russians. But to Rick's point, what's important for the U.S. stock market is what's going on with the economy. You know, I was originally planning to talk about the housing sector, which is slowing down. I think we could see housing prices fall this year, largely because of too much regulation, other factors. So this is a distraction. It's a very important one, but I don't really think we should take our eye off the ball when it comes to what's driving or not driving the economy right now.
Brian Jacobson, what would you think if we saw yields drop as sharply as Rick was talking about? Would that be a good sign or bad? I mean, lower yields help the economy, but at the same time, it's because everybody's so frightened. That's not necessarily a good thing, is it?
Yeah, you can have yields that are too low, and I actually think that that's the environment in which we've been in, is why are they so low? It's not necessarily because there's just so much liquidity out there, it's because there's a lot of fear right now. The Fed is beginning it's a tapering program, but yet this flood of fears surrounding geopolitical events has overwhelmed the Fed's withdrawal of some of its monthly stimulus. So I think that if we do see yields go too much lower, it's all a question of why. And I think that really the reason now is because you'd see a spike in fear, and that wouldn't be a good thing. But again, it's the type of thing that I think that you can just sort of look through and actually think that maybe in a month from now we're going to see that this is actually, we're on to the next story. Let's say what's going on in Venezuela with the protests
rates are
there.
low because there's no demand for credit.
I continue to think that rates are low. We've seen this rally in rates this year, 40 bips in the 10-year in 2 months, because investors really are concerned about some sort of repricing of risk. And this happened 2 weeks after the Fed tapered. That's not a coincidence.
But Abigail, there's no demand for credit in the consumer side.
Well, not on the consumer side, but if you actually look at the consumer's balance sheet, actually credit levels have returned. It stopped declining. There's still demand for credit if you look at commercial and industrial loans that are being made by commercial banks.
Mortgages?
Look at all the new issuances. Yeah, but even on the mortgage side, what's going on there the decline in the amount of mortgages has effectively slowed, according to the Fed's recent figures.
Look
to
at
an
the
extent,
FDIC
demand
data.
is beginning to come back. That's what I'm referring to. It's the decline has slowed. I haven't said that it's come back, but the decline has slowed.
Yeah, I disagree with that also. And if you look at existing home sales, they're at an 18-month low, and everybody's talking about the weather. What about the fact that rates backed up 150
Isn't this a relief we're talking about the economy instead of Ukraine?
Yeah, well,
yes.
Housing. How does that happen all the time?
Yeah, the economy is a little bit more important here, I think.
What's important?
Thank you, folks. Appreciate it very much.
Thank you.
Thank you.
See you later. And, this market really has come back. As you pointed out, the Dow was down 250 points at the lows of the session. The Dow is now down 167 points as we head toward the close of about 50 minutes left in the trading session here.
The conflict between Russia and Ukraine sparking a big sell-off on Wall Street today. Up next, a top military expert